Today's lecture is on monetary policy. Keep in mind that GDP, or the economy in general, could be influenced by two ways. One would be through fiscal policy, change in taxes, change in government spending, and the second one would be monetary policy, or change in the amount of money, its impact on interest rates, and therefore on the economy in general. We will concentrate today on monetary policy. So first, what do we mean and who is in charge of monetary policy? The Federal Reserve, or the central bank of the United States, will be responsible for changing the interest rates, and they will do that through changes in money supply. Basically, this is the sequence of events. A change in money supply is going to lead to a change, delta is change in little I, which is interest rates. And those changes in interest rates are going to influence investments as well as consumption. And when you have a change in consumption and investment, then you are going to have a multiplied change in GDP. Basically, if you would like to reduce unemployment, then we are going to be increasing the amount of money in the economy, which will lead to interest rates going down. Why? Well, because now you have more money available to borrow, and whenever there is more of something than the price, which interest rates are the price for the use of somebody else's money, then interest rates are going to be going down. If interest rates go down, then you will see that it's going to be cheaper to borrow money if you would like to start a business or expand your business, so investments would be going up, and also consumers are going to be spending more now that they can borrow more cheaply, buy new homes, buy cars, and so on and so forth. That will lead to an increase in consumption and an increase in investment, which through the multiplier is going to increase our GDP by a much larger amount than the change in either consumption or investment. So what are we going to do in order to reduce the speed of growth of the GDP and therefore to try and reduce inflation? Well, we'll do just the opposite. Here money supply went up. Here we're going to be reducing the amount of money in the economy, which will then lead to higher interest rates. And since it is going to be more expensive to borrow, then investments are going to be going down, consumption will be going down, and the GDP will decrease by a multiplied amount. So this is basically how monetary policy is going to work. If you were to show that on a graph, then you would show the demand for money and the supply of money. Remember, the supply is set by the Federal Reserve, therefore it's going to be a vertical line. Here the price, or little I, or interest rates, and this is going to be the quantity of money. So if the Federal Reserve was to increase the amount of money, we're going to move to the right. This will be your next supply of money, and that will give you a lower interest rate as compared to the original interest rate that you had before we increased the money supply. And also backwards. If the money supply was to be reduced, then interest rates would be going up. So we are going to be looking at the three main tools that the Fed is going to use to change money supply. And the tools are going to be a change in the reserve requirement. So the tools will be the change in the reserve requirement, the change in the discount rate, and or the open market operations. And we're going to be looking at each to see how this is going to work. So let's start with the reserve requirement. Keep in mind that we are working on a fractional reserve system, and therefore the money that is deposited in the bank, not all of it has to be held there waiting for you to come and withdraw it. You can the bank is only expected to keep a certain portion of it. So let's say that you would like to help the economy grow faster. At that point, you would be reducing reserve requirements so that GDP grows faster. When you reduce the reserve requirements, all banks are going to have excess reserves, and excess reserves means that they have more money to lend out. Given that they are profit oriented, they would like to keep as little as they possibly can get away with in either bank, in the vault of the bank, or with the Federal Reserve. And so if the Fed reduces the amount of money that the bank needs to keep, then that is going to increase the amount of money available. So remember, through the money multiplier, as each bank now has extra money to lend, they are going to be making loans, and those loans are going to work through the banking system and increase the amount of money in the economy by a much larger amount than the excess reserves that will have resulted from a reduced reserve requirement. So you would reduce reserve requirements and therefore give excess reserves to increase GDP. So to speed up economic growth. You would do just the opposite. You would increase the reserve requirements, and as a result, banks are going to be short of money. They will not be able to lend out all that money. We'll talk about how they're going to deal with that later on. So your reserve requirements go up, banks cannot lend that much, and therefore the process of money creation is going to be slowed, and that is going to lead to a decline in GDP. Sometimes we want to slow down the economy, remember, if the economy is overheating. Now, the discount rate would be the second tool that the Fed could use to change money supply. The discount rate is the rate that the Federal Reserve banks charge member banks to borrow from the discount window. It's called the discount rate because the interest is discounted at the beginning. When you go into the bank, you are going to be receiving the loan minus the interest that you will have to pay. Therefore, when you return the money, let's say that you borrowed $5 million, you're going to be getting $5 million less the interest, and therefore you will be repaying $5 million. So if you need $5 million, you'll have to borrow more than $5 million, so that you then will be able to repay the $5 million plus the interest rate. So the discount rate is one other way that the Federal Reserve can change money supply. So to reduce GDP, in other words, to slow it down, they are going to be increase the discount rate. Now it is going to be more expensive for banks to borrow. As a result, they are going to be, that increase in the cost of borrowing is going to be passed on to the borrowers, the consumers. As a result, this is going to slow down the GDP. If you would like to speed up, so to increase GDP, you will make that money cheaper, and therefore you will reduce the discount rate. Now, the reserve requirement is the most powerful tool that you can use. It's powerful because there is this multiplied impact throughout the economy, and because it's so powerful, it is used very rarely. The discount rate is not used very often because if the Federal Reserve would like to reduce the amount of money in the economy, they're not at the same time going to be lending it out. So this is going to be kind of a last resort, lender of last resort. That's what the Fed would be. So which tool are they going to be using more often or most often? And the answer is open market operations. Open market operations refers to the Fed is going to either buy or sell securities. So let's see what happens when the Fed buys. If I'm the Fed, I'm going to be buying from you a piece of paper, which is the bond. I'm going to be giving you a check. So I'm giving you money. What are you going to do with that? You're going to deposit this with the bank. And now the bank has excess reserves, and the bank is going to be lending out the excess reserve. So when the Fed is buying securities, it is going to be increasing the money supply. Correct? The Fed, the Fed, will get a piece of paper, which is the bond. I give you a check, which you deposit more money in the economy, and through the multiplier, even more is going to be created. Now, if the Fed sells securities, then this is the same thing as saying, I, the Fed, am giving you a piece of paper. You, at the same time, give me a check on your bank. And that bank is therefore losing this money, less money available in the economy. So this, again, is going to be the most often used tool. So if the Fed sells securities, then that is going to reduce money supply. Now, we said that we could have a situation where a bank is loaned up. Loaned up means zero excess reserves. They don't have any extra money available. So how are they going to meet the requirements of the Fed if the Fed is going to increase the reserve requirement? Well, they can do this in several ways. One of them is going to be called calling in loans. To call in loans simply means that as on a particular day loans are being repaid, come due, others are being made, well, those loans that have been repaid are not going to be lent out. That money is going to be used to meet the higher reserve requirements. Then, of course, they could also borrow from the Fed or even borrow from foreigners or sell some of their assets in order to be able to meet the higher reserve requirement. But the one that would be the most often used would be your calling in loans. It doesn't mean that they call you up and say, well, Mr. Jones, you got a loan last week and we're sorry, but the Fed, they changed the reserve requirements. Could you please bring the money back? No, that's not what we mean. So as a summary to today's very short lecture, this is what you need to be aware of. You need to know how monetary policy works, and that would be through changes in money supply that affect interest rates, that affect investments and consumption, which will therefore affect GDP. In order to stimulate the economy, we would like interest rates to come down, and to do that, we are going to increase money supply. You can also show that on a graph, whereby here you increase money supply, interest rates are going to be dropping. The three tools that we use to change money supply are reserve requirements, discount rate, and open market operations. This reserve requirement change is the most powerful tool. Because it's so powerful, it's going to be used very rarely. The most often used tool is going to be our open market operations, which is the FOMC, Federal Open Market Committee, FOMC. And they are in charge of buying or selling bonds in order to influence the amount of money in the economy. The discount rate is really not that important because it is only a last resort situation. So hopefully this, along with the lecture on money creation, is going to enlighten you as to how the Fed changes the amount of money in the economy in order to either speed it up or slow it down. Later on, we're going to compare monetary and fiscal policies. Thank you.